Last time I talked about Star Wars. This time I'm going to talk about Wile Coyote, my friend. And Ben Bernanke gave a talk in June, and he said in 2020, Wile Coyote is going to go off the cliff. And he's going to look down, and that, meaning the stimulus, will be withdrawn at that point. And so we call, that's why, and I also have a question mark about Wile Coyote. Is Wile. So we're not forecasting that for the economy. All right, our main themes is, as we said for the past couple of quarters, is we're on a 3-2-1 growth path. And by that I mean is 3% growth this year, 2% next year, and then 1% in 2020. And this is based on a fourth quarter to fourth quarter basis. And as the federal fiscal stimulus wanes, coming both from huge spending increases as well as the tax cuts, and most of the financial press has underrated the big increase in spending that was agreed to by the administration and Chuck Schumer. That's going to wane in 2020, and I think that's what Bernanke was talking about. In the near term, unemployment is going to drop to 3.5%, maybe even a little bit lower. Inflation is going higher, call it from the low 2% to the high 2%, maybe even the low 3s. The Fed's on a path to raise rates, and they're going to raise rates we'll know at 11 o'clock. They will announce they will raise the Fed funds rate another 25 basis points from 1 3/4 to 2 to 2 1/4, and that's 99.75% likelihood to happen this afternoon. But they will continue raising all through 2019, in our opinion. The deficits, we're going to have deficits of $1 trillion plus from 2019 on, and probably on the road to $1.5 trillion. And that's assuming no recession for the next 10 years. And if you get a recession, it'll be $3 trillion. We'll have a monster deficit. And the biggest risk continues is no one really knows what the administration is going to do with respect to trade. And the Wall Street response is they assume we're going to muddle through and they're going to make a deal. That's why stocks have been doing so well. If that view changes, then we're going to have a big problem in the stock market as well. All right, here's our GDP forecast. You see the first quarter was sort of a 2%. The second quarter was a 4%. You average that, that's 3. We have a couple of 3s coming in this quarter and next quarter. And then gradually tapers off, and we're down around 1%. In 2020, sub 1% growth. And when the economy growth gets that slow, any little wind could knock us over, and you could have a risk of a recession. So although we don't see a recession in 2019, maybe 15% chance, which is sort of a normal chance. In 2020, you could talk 1 out of 3. You could talk a much higher risk in 2020. Okay. All right, this is the deficit picture. And the deficit picture, deficits were coming down from over $1 trillion coming out of the financial crisis under Obama, and they dropped as low as $400 billion. But as you could see there, we're going to be going over $1 trillion starting next year, and as high as $1.5 trillion in the out-year periods. And this is sort of really running on automatic pilot. This is just assuming current tax law, current entitlement programs, no new major spending programs, no new major programs in defense. So this is sort of running on automatic pilot, assuming no recession, deficit explodes. Now, Republicans obviously don't care about deficits. And believe me, the Democrats are not going to care about the deficit either if they gain control of Congress. They just want to spend money on different things, and they may want to raise taxes and maybe spend more money on other things. So the deficit is on a path to go much higher. And the only way we sort of solve this problem, there's 3 ways to solve this problem. Way number 1 is raise taxes sometime in the 2020s, cut spending a lot sometime in the 2020s, or we try to inflate our way out of it and have the economy, nominal GDP, just go real fast so the deficit comes down. And that's a possibility. Those are the 3 ways to get out of this, and we'll see what happens. But that's beyond our forecast period. All right, the other way of looking at it is we have a fiscal hangover in 2020. We have this debt-fueled expansion in 2018 and 2019, and then it sort of wears off, and we wake up in 2020 with some kind of a hangover from the stimulus coming from the debt. So all we're really doing is we're pulling forward some demand, and then comes 2020, there's nothing left to pull forward, and the economy slows down. And because we're assuming we're not going to get further tax reductions and further spending increases in 2020 to keep the party going. All right, employment's on a growth path, but employment is going to slow. We're not going to get to 200,000 a month that we've been used to in new non-farm jobs, but it's going to gradually slow because we're running out of people. The economy is roughly at fully employed, so we will see job growth drop to 150,000 a month, then 100,000 a month, then 50,000 a month. And in the end, we actually have it flattening out and dropping a touch. But it's going to be very hard to sustain the 200,000 jobs a month we've been used to for the past several years. Next slide. Unemployment in this environment, unemployment rate drops to 3.5, and for modeling purposes, as the economy slows, we have unemployment ticking up in end of 19 into 2020. But yeah, it's still 4.2%, so there's not a recession. There's nowhere near what you would call a recession kind of a number. If you get a recession, typically unemployment rate goes up by 300 basis points. So it'll go from 3.5 to 6.5 if you have a recession. So nowhere near recession. Okay. One thing is we've been waiting to see employee compensation increase, and we've been wrong on this for a while. But last month, on a year-over-year basis, our average hourly wages were up 2.9%. Anecdotally, we hear all kinds of things about all kinds of pay raises. Walmart is giving $5,000 a year, $5,000 bonuses just to be a truck driver, for Walmart. And I look at the BLS data for trucking employment, and you hardly see any kind of wage increases. So you sort of scratch your head, is the wage increases seem to taking place everywhere, but it's not in the data. So my guess is the data is going to get revised higher on the wage numbers. I think that when they recalibrate this next year, we'll find that wage increases are actually been higher than what's been reported. Anyway, I just look at the trucking numbers, and it makes no sense when there's a national truck driver shortage. And you see Walmart paying up, and oil patch, they're really paying up. So we think we're going to see wages pop into the 4% range. In terms of inflation, the inflation rate is now above target. We're going to be at 2% in the low 2s, and we're going to head to the 3s. The blue line is headline inflation, which counts for oil prices. The yellow line is core inflation. And we see that around 3% or very close to 3% at the end of the forecast period. Part of that's coming from wages. We do not have in this forecast aggressive assumptions with respect to the price of oil. Price of oil right now, WTI is around $72 a barrel. We have it at 70, averaging next year at 70. So it's nothing aggressive, and in 2020 it's averaging 76. So we do not have any kind of aggressive assumptions on oil. And the thing is even though with shutting down Iran from the market, and because of sanctions and the collapse in Venezuela because their economy is in complete shambles and they haven't invested in their fields, the oil production in the United States is exploding. And if those of you don't realize, is in the Permian Basin, which is southeast New Mexico and West Texas, we're producing about 3.5 million barrels a day right now. That's like Kuwait. It's going to be 4 million barrels a day next year once the pipes get built, on the road to 6 million barrels a day. This is one of the biggest oil fields in the world. To put that in perspective, Saudi Arabian oil production is 10 million barrels a day. So there's a little chunk of land in the Permian Basin, West Texas and southeast New Mexico, 60% of Saudi Arabia, and that was only 1 million barrels a day like a few years ago, and just ramping up. So we have a lot of domestic supply over the next several years. Next slide. Okay. All right. Our interest rate forecast is for the Fed to raise today. That's baked in the cake. Fed to raise again in December, and then we have 4 rate hikes next year, which will take the funds rate over to 3%. The market right now is only anticipating 2 rate hikes. Okay, the Fed dot plots, which we will get from what the governors, what the FOMC members think where rates ought to be, probably will show 4 rate increases also, like they did last quarter. So our sense we're going to have 4 rate hikes this year. And Lael Brainerd, a governor on the board and also a member of the FOMC, historically a dove. Historically has been a very, very low interest rate person, let the economy run. Lael made a speech 3 weeks ago saying we're going to have to do more earlier because of all this fiscal stimulus, this fiscal policy, and we're going to have to raise rates above normal. So this is a dove who wanted to keep rates below whatever she considered normal. Now she wants to have rates above normal. The head of the Chicago Fed, Charlie Evans used to be a dove. He has now become a hawk, and he also wants for higher rates. So the whole mix on the board between a low rate policy and a high rate policy has shifted. And so we think we're going to see the 4 rate hikes, and that is not yet in the market. But part of the recent rise in both the 2-year bond rate and the 10-year bond rate over the past 3 weeks is the market has finally begun to notice what Lael Brainerd said 3 weeks ago, and we're going to see what Chairman Powell says this afternoon at his press conference. We also have long rates going to 4, then rolling over, and we see this big drop as the economy slows. We have the Fed easing a little bit at the end of 2020, and we have long bonds coming down. Now, one of the risks here is with a trade war with China. One of the weapons that China has is China could say, they could decide not to buy our bonds or sell our bonds. And if the Chinese decide to sell our bonds, then we could have a much worse bond market than what we're forecasting here. In the late 80s, we'd had a trade dispute with Japan in 1987. And in August of 1987, Japan decided not to show up at a treasury auction. The market panicked and interest rates jumped 100 basis points in 2 weeks. Just because Japan didn't show up. They didn't sell. They just said, we're not going to buy. Didn't show up at the auction, and the market panicked, and yields went from, I think, 8% to 9% at that time in a 2-week time period. And that was one of the precursors to the 87 stock market crash. Okay. The other thing going on is aside from all this bond issuance coming from the deficit, the Fed is selling. The Fed wants to normalize its balance sheet. So the Fed is selling bonds. And our guess is, and sort of what the Fed has said, they're talking about selling $40 billion, $50 billion a month of treasuries and mortgage-backed securities. So if you just think about the numbers here, the deficit is going to put in the market $80 billion, $90 billion a month on average, new issues, net new issues of bonds. You're going to have $40 billion a month selling from the Fed. That's $130 billion. And if the Chinese decide to sell, you got more. So you got supply forever. So this is going to be an environment. It's going to be hard to get rates lower in this kind of environment, especially with the Fed tightening at the short end. So that's part of our argument for rates to go higher. All right. As far as the economy goes, consumer spending had a big rebound in the second quarter from a very sluggish first quarter. And consumer spending will be in the 2.5s for the rest of the year, then drop to around 2%. But the very interesting thing about consumer spending is restaurant and bars. Restaurants and bars, and it's very discretionary, it's a sign of how strong the economy is right now, up 10% year over year. This is plotted through July year over year. If I plotted it through August, it would be a little bit higher. It was under 9, just under 10 in July. It's over 10 on a year over year basis in August. Now, I have a very cheeky explanation for why the restaurant and bar business is doing so well. The people who like Trump are celebrating and they're going out to eat and drink. And the people who don't like Trump and are depressed are going out to drink and eat. And that's why restaurants and bars, so they're in a good business right now. They cater to everybody. Okay, this is equipment spending. Maybe this will, could you lower this, get this slide better there, George? So people could read the top. Okay, so equipment spending, which dropped in 2015, rebound because of the oil problems, the oil patch, rebounded to 5+%, is now 7%. One of the things powering the economy is equipment spending coming from the tax cuts, coming from deregulation, and coming from 100% expensing. Okay, the next thing is this is the real defense spending. Real defense spending was a long-term contraction starting in 2010, but given the budget, it's going to be up 4%, close to 4% this year, over 4% next year. This big ramp up in defense spending. It's also going on in non-defense. But if you notice in 2020, the increase is gone. The increase is minimal. So this is going to affect all federal spending. This is part of our example where the economy, we have this Wile E. Coyote moment where we run into a wall of some kind. Is all of a sudden that there's going to be less stimulus coming from defense in 2020 compared to 2018 and 2019 because you're growing 4%, and all of a sudden you're at 0.5%. That really will slow things down and take away from growth. So one of the things that's helping right now is this big ramp up on the defense side. Okay, housing starts have been just very disappointing to us. Yes, they're increasing, but the demographic demand, the way most people calculated it, is 1.5 million to 1.6 million in new starts. We're not even going to get to 1.4 million this cycle, in our view. And that's been puzzling because normally when housing goes down hard, it comes back really strong. This time it hasn't happened. And our explanation is where there is very strong housing demand, prices have skyrocketed, have gone up a lot because of employment growth. And in those very same areas is you have very strict land use control, so supply can't respond. Supply can't respond to the demand, so you don't get an increase in starts. It shows up as higher prices. It doesn't show up as activity. And that's a supply side issue. From a demand side issue, you could argue is that this $1.5 trillion of student loan debt out there in the system is keeping younger people from buying homes because of the higher student debt. So that's a demand side issue, and you also have a supply side problem. And the average for housing starts going back to 1959 to the present is over 1.4 million. So this is an upcycle. We're not even going to get back to the 60-year. We're not even going to get back to the 60-year average in housing starts this cycle. And we have housing starts gradually dropping because interest rates, mortgage rates will be higher. Mortgage rates, instead of being, let's call it 4.5 right now, maybe 5.5 at the end of 19, something like that into 2020, and that will slow things down. Okay. All right. Now the risk is trade. The president is proposing tariffs on all Chinese imports. He's had 50 billion is done. There's 200 billion announced coming, and then he says he wants to do the rest of the other 287. So it's 537 billion. That's what we imported last year from China. If you put a tariff of 15% on that, that's $80 billion tax on the economy. So that undoes a lot of the tax cut. You know, over 10 years, 800 billion. Now, of course, all of that won't be paid because production will shift to Thailand, will shift to Bangladesh, will shift to Vietnam. But that's just going to be a giant tax on the economy. And so this is going totally counter to what the fiscal policy of the administration has been is to have huge fiscal ease, which, by the way, this fiscal policy is completely unprecedented in American history because we've never had a huge stimulus on a fully employed economy in peacetime. We've had it in wartime, but we've never had it in peacetime. So the policy is really unprecedented for peacetime in the United States. But that $80 billion, that's an $80 billion tax on the economy. Other thing is NAFTA could unravel without Canada participation, because it isn't clear we could back out of NAFTA without direct congressional approval. So when Trump is saying we'll just make the deal with Mexico, it may not happen. And there's also a whole boatload of congresspeople in both parties who will vote no on just the Mexico-only deal because their states are intimately involved with Canada trade. And that's New York, Ohio, Indiana, Wisconsin, Michigan, Minnesota, all these northern tier states which are intimately involved with trade with Canada. So NAFTA could go away, and that would really mess up supply chains. The other thing is there still risk remains with respect to auto tariffs. Trump was going to propose tariffs on all European and Japanese cars coming in. He's backed away from that, but if he decides to do that, that's more trade mess. So the thing is this trade situation is if it gets out of hand, and every day it gets more and more out of hand, it's a huge risk for the economy in 2019 and 2020. And then lastly is several of the emerging markets are unraveling with currency crises, and namely in Turkey and Argentina, but there's also other places, and that could sort of upset the global economy. And Italy is still a total mess and continues to be a total mess, and that has an impact on the EU. So we watch Italian bond rates, we watch Italian short rates, and we look at at what's going on in Turkey and what's going on in Argentina. And even though our stock market has been doing great, not so for the emerging markets. This is a Vanguard emerging market ETF, exchange traded fund, and that's down 20% since the start of the year. So while our market has been up round numbers 10%, emerging markets as a whole are down 20%. So the impact of the trade policy, the rising rates in the United States, although it's not showing up in the US economy, it's showing up far away, and that could come back and bite us next year or the year after. And no matter what the administration talks about trade, the real net exports or the trade deficit is going to go over $1 trillion in 19 and higher in 2020, because the trade deficit with an individual country, it has to do with micro issues on the prices in China versus the prices in the U.S. and stuff. But the whole overall trade deficit is a macro issue. It depends how much money we save, how much money we invest. And if we consume more than we produce, we have to import stuff. And that's just the arithmetic of the GDP. So as a result, as our strong economy is, we're just sucking in imports. And that's why we're generating this huge trade deficit. So every day, Trump is going to say we're doing all this stuff on trade, but he's going to see every month he's going to see the trade deficit go up, as opposed to trade deficits go down, even with all the tariffs. So to conclude, is the near-term deficit fueled growth is going to give way to a slowdown in 19, especially in 20, with trillion-dollar deficits forever. Unemployment is going to drop to 3.5%. Inflation will be higher than it is now, and the Fed's on track to raise rates. Housing is going to continue, even though growing will disappoint. And the biggest risk has to do with trade policy. And so far the stock market is ignored, because the argument people tell me, well, David, if everybody's worried about trade, it would show up in the stock market, and the stock market's making new highs. Why is that happening? And I'll leave you with the answer is the consensus on Wall Street is that we will muddle through, we'll make a deal, like what happened with Korea. We had this big fight with Korea. Trump, according to Woodward, was about to tear up the whole Korea deal right away as soon as he came into office. And now he just signed the deal with Korea. This is all bluster. It's not going to mean anything. And by the middle of next year, we'll make nice with Mexico, make nice with Canada, make nice with China, and everything will be all fine. That's the explanation why stocks have been doing so strong in the face of this risk. So thank you very much.